Hey, welcome back to The Dive. Today on the show, we have the global market analyst at Crescat Capital, Tavi Costa. He's joining us today to share his thoughts on NFTs, inflation, oil, gold, silver, and he's going to walk us through a few of his charts. Hey, Tavi, welcome back to The Dive.
Thanks for having me again.
Okay, so let's start off with a topic that you rarely cover. Former President Donald Trump launched $99 digital NFTs to drive excitement among investors in the digital world accusation SPAC. What are your thoughts about NFTs?
Well, I don't think I'm an expert to really answer that question, but I'll try to. I think it's in a way potentially revolutionary to a certain degree. Right now, it's more of a contrarian thought about the situation, given the fact that most of those assets have completely collapsed over the last months, particularly. But I think there will be things that will come out of that. I don't fully have my arms around the opportunities. I don't think I need to at this point, just because I think there is other opportunities that are maybe more timely. And there will be a moment when those things will come back. I think it is a form of another way of finding access to capital. Obviously, right now it's been quite difficult to get that. However, it will be another form of another way of really capitalizing on access for capital and really hopefully even capitalizing on different ways of community building and things that are related to those developments.
Let's talk about the latest inflation data. The November U.S. CPI print came in at 7.1%, the biggest decline since April 2020. Where do you think that the Fed will go from here?
Well, I think, first of all, on the inflation front, usually inflation develops through waves, and I've used many charts to express that view over time. And while people get very technical about the timing of everything, I think that we've seen the first wave, most of the first wave, I would say, have already occurred. And so we've been in this kind of downward trend of decelerating growth of inflation since the peak, which will mistakenly, in my view, cause investors to think that this is the end of an inflationary problem. But it's important to think that the structural causes of these forces are actually still there. They have not been resolved. And that's why they're structural and also secular in with that nature. So those are the wages and salaries growth are things that usually don't begin and just end. Those are very difficult trends to reverse themselves over time. And so those are usually, they tend to be very long-term trends when they are initiated. The second one has to do with the shortage of commodities in general, which is one of the main issues that have certainly not been resolved. And the lack of access for capital and difficulty because of the monetary tightening and so forth is only making that issue even more pronounced. And I don't think that's going away. And we know that there is a lack of not only discoveries, developments of new natural resource projects, but also producing assets are shrinking over time in different parts of the natural resource industries. And the third one has to do with the reckless amount of fiscal spending. I mean, if you look at the average amount of, or today's fiscal spending in the last 12 months versus what we saw in average on an annual basis in the 70s, it is way higher than it used to be back then, even inflation adjusted. And that is such an important point because we're seeing reckless amount of fiscal spending today, given the fact that the agenda is so large. Got green revolution, peak inequality. Countries now have been forced, especially developed economies, to sort of reconstruct and rebuild their manufacturing plants. So all those are part of the pillars of inflation. And the fourth one, which is the most important one, is the deglobalization trends that I think really initiated back in 2016 and now are intensifying over time, and which is why I don't believe we are in sort of a 1940s period type of inflation, because the deglobalization trends at that time was actually at the very end of it, right at the end of the World War II. And now we're at the beginning of problems. I'm not calling for World War III, anything like that, but certainly the geopolitical tensions are rising, and I don't think that's the end of it. Usually those trends also tend to persist over time. So overall, inflation is likely to stay higher than prior decades, even though we may see a deceleration. I think in this decade, we're going to see double digits inflation growth at some point. I think that will come back as a narrative later on. This recession narrative is growing. There's a lot of downturn pain right now, but I think that narrative will come back. And so those are my views about inflation. And I guess I didn't answer your question about Jay Powell, but look, I think we're probably, I think he's going to follow through with his agenda of really not being able to, or not raising rates, or starting to reduce the pace of raising rates. I think that's really priced in the markets mostly. So I don't think there's really of a view there, but I think we're starting to see the change where bad news will become bad news, and we're going to get to the steeper part of the recession, because one thing is to take interest rates from 0 to 4%. The other thing is when you go from 4 to 6, and that range usually is when you start seeing frauds beginning to be revealed, or really the naked people starting showing up because they're really naked, because there's no empire there. So those are really my thoughts about the economy. I'm very bearish in the economy right now, especially in the equity markets. Still remain bearish, and I think we're going to see the developments of that still in the first quarter of 2023 and the second quarter of 2023 still probably going to go on.
While we're on the topic of inflation, let's pull up one of your charts. What does the three inflationary waves of the 1970s chart tell us, and why do you think that this is relevant to the market today?
Well, it's sort of a roadmap for where we are. What I was referring to, those three waves are very important. While we've seen those three waves in the past, not just in the 70s, but even after the Great Depression, we also had other three waves that were increasingly higher over time as well. So we saw higher highs. And the idea of the waves itself has to do with how this tends to occur and unfold, is really the changes in not only behavior of businesses, but also consumer behavior in general, that begins to react differently when you're in an inflationary period or an inflationary era. And you start to see really shortage of materials. You start to see over time also the need for higher wages and salaries because of the standards of living, and all those things tend to cause a lot of political pressure. The political pressure brings back national agendas in general as well, and then from there you start seeing geopolitical issues begin to unfold, and so it's all connected in a way, and so I think it's important to look at that with the lenses of, we're going to see probably a deceleration from here in CPI, which is going to impact the way the Fed is going to behave towards this, which is going to be key for this kind of commodity trend, because, any sort of early pivoting moment for the Federal Reserve is certainly going to, in my view, ignite another move in this commodity trend on the upside. And so, and that's really because CapEx are still the trends in CapEx and capital spending are very depressed, historically speaking. And like I said before, geologically, it's still hard to find most natural resources. And the development of them has been very small relative to other parts of history. And the adding of reserves of natural resources has also been very small relative to history. So, I think this is the beginning of an interesting era where investors will be favoring tangible assets, will be favoring owning commodities over time. It's a change of the 60-40 portfolios that have been completely failing, forcing new portfolios, or it's, I guess, forcing folks to reconsider what should be the more conventional capital allocation over time, which I think will look very different 10 years from now than what has been recently with owning equities and bonds in general. I think that that's going to shift in a large way, and I think gold and commodities will play a role into becoming a bigger part of those portfolios over time.
Okay, now let's shift to the U.S. commercial and industrial loans chart. Could you walk us through this?
Well, the idea of that chart really is the surge that we've seen in commercial loans. I think it was a $300+ billion increase in the last 12 months. And the real issue has to do with corporations that have been increasing the amount of issuances of debt recently. So they've been leveraging up recently at a time when interest rates are much higher. So the cost of debt will increase and squeeze their margins as well. But this is very similar phenomenon that we've seen with the consumer behavior too, which consumers, you look at the saving rates declining over time and went from historical highs to historical lows so quickly. And in the middle of that, you're starting to see consumer loans also begin to increase. So both are also connected. And this is really the pain of inflation, where you start seeing the squeezes either from margins or balance sheets in general being squeezed because of the higher cost of different things in general. So for consumers, is really mortgage rates, wages, and salaries that are not keeping up with inflation, and the general cost of living as a whole, with still expensive rent and even purchases of homes with house prices still elevated historically. All those things are playing a role into causing a shift in consumer behavior. And the same thing is happening with corporations today that are being forced to rethink about their balance sheets as well, at a moment when we're starting to see the downward pressure from their fundamentals, which we haven't seen in a while. And that is the beginning of a contraction in terms of bottom line and top line for most businesses that I think will persist, especially in the next 6 to 12 months. And that will need to be, in my opinion, reflected in equity prices over time. So that's why I think there's further downward pressure in equity prices, because balance sheets are worsening, not improving, and fundamentals will add to that downward pressure as well.
Now let's move on and talk about oil. HSBC has announced that they will stop financing new oil and gas fields as part of its efforts to drive down global greenhouse gas emissions. How much of an impact do you think that these decisions will have on inflation a couple of years down the road?
Huge. It's creating perversely one of the best setups to invest in oil and gas that we've had in many decades, I believe. And that has to do with, yes, the green revolution is likely to occur just because of the institutional capital chasing those developments as a whole. I think will force that at some point. However, in the meantime, we still need energy commodities to function the global economy. Therefore, there will be a lot of opportunities in the space. And so those companies still trade at very cheap multiples today, despite the recent, we've had 2 back-to-back years, incredible years for energy companies in terms of performances in 2021 and now this year as well, even with the recent decline that we had in equity prices. So all those things are adding up to, it's sort of completely contrarian to what I believe most analysts in general would have thought it would have happened, with most of those ESG mandates forcing companies to not invest in energy, in the energy space. And so personally, I think this is, again, setting the stage for a big rise in energy prices over time, also creating a floor for the recent decline that we've had. And remember, the geopolitical tensions are not the end here. It will probably continue to emerge here over time. And if that's the case, that should be another positive backdrop for oil as well. So all those things, in my view, are going to add to the inflation problem as well. And I think this is positive for the energy sector as a whole. I mean, remember back in the days, most energy companies would be so completely focused on production. That's what most management firms or management of those firms would actually get paid for, and get bonuses for increasing production. And today, they just get paid for, or they are incentivized to really improve their margins in a sense of reducing cost and capital spending in general. And that's a problem. Structurally, that's a problem long term. And this is why I think it will provide an opportunity to invest in the space over time.
Okay, now changing gears. We have here the gold and silver miners net acquisition versus cash flows chart. Can you walk us through your thoughts here?
Yeah, I think, just similar to what we've seen in the energy space, what we're seeing here in the mining industry is somewhat of a paradigm shift happening, which has to do with the fact that not only gold companies are now losing faith and interest in gold itself. It's kind of weird to say this, but most gold companies have been reducing their production over time for many reasons. Some others have been increasing their exposure to other what they call critical metals, which are part of the green revolution that will be part of to supply the metals that we need to make the electrification efforts over time, and reducing their focus in gold itself. And again, similar to what's happening in the energy space, this will be, in my view, a way of magnifying the trends for mining in general, and it will be very positive because the decline in production that we're seeing in most of the major companies, I mean, think about Barrick, for instance, is the second largest gold miner in the world, is facing a secular decline in gold production in terms of ounces since 2007. If you look at Newmont, the largest producer of gold in the world, that one has the lowest or has the same production that he had 15 years ago in gold terms. And so all those issues are quite interesting from a perspective of the fact that first you have the negative sentiment coming into the space from more generalists and overall analysts. And now you're seeing the sentiment also shifting from most of the management firms, which are not really seeing the reason to really mine gold. I think this is one of the most positive things happening in the gold space that you could ever think of. And I know this is a total contrarian view, but I say this with so confidence because we've seen this in the past. And the fact that we're seeing a beginning of a decline in global production of gold, it is precisely what marked the bull markets that we've had in the 1970s and the early 2000s. Was also on the back of a long-term declining trend in production of gold. And so this is very, very important development in the gold space. And to your point on M&A, M&A is one of the best ways to really follow where we are in terms of identifying the stages of the cycle of mining today. And certainly we're at very early stages because companies are improving fundamentally. They're making near record cash flow generating businesses at a time when they're not spending on anything. And usually companies go on a buying and spending spree when you're at the peak of the cycle. And today we're seeing the complete opposite of that, which makes you believe that you're at near the bottom rather than the other way. So I'm very positive in the space in general, and I think will be one of the best performing industries in the next 12 months.
Last question we have for you here. What do you think needs to happen for precious metals to make a significant move higher?
A lot of things, and I think we've had an important signal recently that, in my view, gives even higher conviction in this idea, which has to do with the percentage of yield curve inversions. We've had about over 70% of inversions in the U.S. Treasury curve. This, to me, is one of the most important macro signals to really buy gold and sell stocks. Historically and empirically, every time we've had over 70% of the U.S. Treasury curve inverted, it marked incredible times to be long gold and short the S&P 500. And given the fact that the S&P is already down significantly, and even if you look at NASDAQ, down over 30% already from its peak, it makes you believe that the gold side of the leg could work even better. But I like to have both. meaning I'm long gold and short most equity markets, especially in the US. But I do believe that there are major opportunities in the gold space. And it's important to know there's a lot of big long-term trends occurring here. One of them has to do with the 60-40 portfolios. The conventional 60-40 portfolios have been completely failing and will force investors to look for other alternatives. And I think gold will play a big role into being that defensive asset, given the fact that it does have a pristine track record of performing well, not only during inflationary periods, but even deflationary periods. It's just a very good defensive asset, high quality asset that performs well in many different environments. And so I think that given the fact that we've seen such a huge run over the last decades of treasuries relative to gold, I think it's time for most investors to start buying gold in general. And now the other thing that will happen that is a bigger part of this pie of the puzzle, the macro puzzle in general, has to do with what central banks do. They drive liquidity. They drive the demand for precious metals. The demand for precious metals really comes from one thing, that is central banks. And today, central banks, if you look at what they hold in terms of their foreign reserves, including gold, they only hold about 17% of gold relative to the overall reserves. And back in the 70s and the 80s, we saw a peak of 74% of their reserves were actually gold holdings. And so we're way too far from that. And I think that the pressure, given the pressure that most of the central banks are facing in their own fiat systems and their own fiat currency systems in general, by being, the value over time, I think we're going to see the need for most central banks to improve the quality of their international reserves, which will force central banks to buy gold. And so I think that ratio that I just discussed, which is the percentage of gold holdings relative to overall foreign reserves, is poised to rise significantly from here, and especially for the next decade. And that's going to create really the very important side of the demand for precious metals in the next years. And so I'm extremely bullish, and I think that will play out very well for most gold investors over time.
Okay, great. Well, thank you so much for coming on and sharing your expertise with us today. I hope you have a great holiday season and hope to see you again in the new year.
You as well. Thanks for having me again.
Thanks so much for watching today. We will be back again tomorrow. So in the meantime, you could always check out one of our other videos and hit that subscribe button if you like content like this.